Greetings from Big White in Canada, where it's currently minus 12 degrees outside, but not too bad inside. I hope this finds you well on Monday. I just thought I'd start the new year by trying a new medium for communication and to actually address some of the madness that's happening in financial markets around the world and in the press. So I'll kick off with the big news this week that the Royal Bank of Scotland has advised their clients to sell everything. They came out saying, brace yourselves for a cataclysmic year, and think that things are similar to 2008 when markets fell, credit froze. It was a pretty dark time in the financial world. So I thought I'd trace back to see what track record Royal Bank of Scotland has after having made such a bold call, and it was pretty hard to find anything of any substance or actual productive use in their recent history. In 2008, when the European stock market fell by 50%, there's very little on the newsreel that Royal Bank of Scotland evidence for the Royal Bank of Scotland suggesting their clients to sell out to miss that massive downturn. If you look back to June 2010, they have a statement saying, "We cannot stress enough how strongly we believe that a cliff edge may be around the corner for the global banking system." Turns out that in the following 5 years, the global banking system actually regained and regathered its feet. And US and European stocks were almost doubled over the next 5 years. They were up in the vicinity of 80 or 90%. So on those two occasions, had you followed RBS's advice, you'd probably have a little less in your wallet today, thanks to that. One of the other big items doing the news is the price of oil, plummeting to $30 a barrel. Some people saying that that's going to affect the stock market a whole lot. From what I've read and what I've seen, there's no clear connection between the price of oil and the price of stocks or the performance of companies, which is actually what a stock price is. Researchers at the Federal Reserve Bank of Cleveland have done an in-depth study on this and found that over short periods of time there can be correlations at the extreme high and the extreme low prices of oil. But in general, there's no strong correlation between the price of oil and the profits of businesses, with the exception of specific sectors. So with the energy sector right now, probably hurting a little bit because the price of oil is so low. On the flip side, transportation and companies that move things around and burn oil to generate profits are probably going to see an uptick in their profits. But overall, oil, not a big driver for stock prices. China, big story is fall in the Chinese stock market. If I can share this chart with you, and I'm not sure if I can, that's not terribly surprising. The Chinese stock market is up about 150% over the last 12 or 13 months. So to fall back 10, 15 or 20% after you've gone up 150, again, not too big a surprise there. Looks to be driven largely by data emerging that suggests the Chinese economy is growing at 6% rather than 7%. Kind of wow, hey? That's still 2 to 3 times the growth rate of pretty much the rest of the developed and developing world. So they're still not about to shrivel up and die just yet. Peter Switzer, a prominent Australian business person, he's pretty bullish on the Australian market and Australian businesses. He cites low unemployment, low cash rates, new home approvals, rising tourist arrivals all point towards a pretty vibrant and healthy Australian economy there. So he kind of doesn't see too many issues there for Australian stocks and Australian businesses over the coming 12 months. So what's an investor to do with all these conflicting messages around? I guess it's helpful to remember that in order to generate or to target a return of higher than the cash rate of the return, you have to accept some risk. And with that risk comes price bouncing around or volatility. So we don't pretend to be able to avoid risks altogether, but we try and manage them where possible. So some of the ways we do this is we diversify. So we diversify across many different businesses, many stocks, and many countries and many economies. I tend to think holding a single stock is very risky. For example, BHP. If you held BHP 5 years ago, it was nudging $50 a share. I'm pretty sure you can pick it up today for under $15. So while a 10 or a 20% decline in short-term investment value is hard to stomach, I mean, going from 50 down to 15 is, that's a 67% haircut. That's a pretty big decline. So we like to diversify. Secondly, if you don't have to sell, don't. Prices become less relevant if you aren't actually selling your investments. So particularly for those of you that are at or near retirement, it's the income your investments generate that is the key. The price is important too. I'm not going to discount that, but it's really what income can your investments throw out. So don't sell if you don't have to. We control asset allocation and we try and rebalance. So we systematically rebalance, which gives us a mechanism to top up when prices are low and to sell a little bit when prices are high. And balance the amount you have, in shares and property versus safer assets such as cash and bonds. So if Alan Kohler reports on the ABC News that stocks are down by 6% or whatever it might be, remember, most likely you've got only about 50% or less of your total investments exposed to shares or businesses. So you're not going to see the wild gyrations that Alan Kohler or any analyst for that matter might show in their charts. And another thing you can do is just re-rate your risk tolerance. Do you need to target a higher than cash return? If you've saved enough and you know your spending limits, I think it's pretty difficult to survive on cash rates at the moment, which are 2%. Large Australian companies are paying dividends of 4.5%. When you add in franking, that turns out to be 5.5% to 6%. That's a whole lot more attractive than cash rates of 2 or 2.25%. But if you genuinely can't tolerate the ups and downs that comes with investing, then it might be worth having a look, and we can discuss re-rating your risk profile and reallocating how much you do have exposed to at-risk investments. History and my personal experience shows that if you're able to keep to your plan during crazy times like this, and stay in your chair, you'll be far better off than those who are trying to play musical chairs. There are some people who sometimes get predictions right once or maybe twice, but try as I may, but it's very difficult to find anybody that can successfully and repeatably forecast what's going to happen in financial markets. So with that, I will wrap it up and look forward to hearing back from you. Thanks, and see you soon.